大家好，欢迎回到我的节目。今天呢，我们不复盘，因为这个频道是去年差不多这个时候开始的，过几天呢就是一周年的纪念了。今天呢，我给大家带来了一个非常非常特别，然后重量级的这个节目。那这个节目是什么呢？今天的这个节目就是跟 Rick 的一个采访。Rick 是什么样的一个人呢？给你们一个简单的介绍。他是在1974年进入这个对冲基金投资管理的行业的，然后呢，自己开了自己的公司，叫做 Global Resources Investment。到了那个时候之后呢，就到了这个 GFC 了，当时的金融海啸。金融海啸后期，他就通过这个并购，成为了另外一家美国著名贵金属对冲基金的 CEO。他也曾为多家上市公司，我们现在能找到的上市公司提供个人的私人流动性，对吧？就是借钱给他们嘛。所以他是非常有资历的这样的一个老牌投资人。尤其是在现在黄金这么疯涨的一个时间，我觉得把他请来能给大家提供非常非常多的价值。退休之后呢，他就投入这个专业投资人、机构投资人的这个培训以及教育了。他也有自己的网站，他所有的连接，包括这个视频中提到的几本书呢，我都会放在评论区。今天这个采访呢是英文的，等一会儿这所有的就变成英文了。然后呢，如果大家有需要的话，我可以提供一个中文版文件版的这个 transcript， 就是今天我们讲的这些内容，每一句话都会给你写出来。如果你有这个需求的话呢，请在评论区告诉我。那我们呢就直接开始，欢迎 Rick。Well, Rick, thank you for joining our show today. It's a true honor to have a legendary investor like yourself coming onto my program. The gold trade right now is absolutely crazy. I'm sure you know about this, but right now, every retail investor seems to want a piece of pie. So could you tell us a little bit about what's going on in the gold market right now? Why is it going up so much?
I think the increase in the gold price reflects deteriorating savings and investment confidence in fiat currency denominated savings products, in particular, faith in the US dollar, which has been viewed as a storehold of value and the benchmark saving instrument on a global basis. It's worthy to note that the US dollar isn't just losing purchasing power in an absolute sense. The US dollar is down relative to a basket of other currencies by 10% this year. My own belief, for what it's worth, is that the US dollar will hold its own against other currencies, but that the absolute purchasing power of the US dollar will deteriorate substantially over the next 10 years. So I think the express concern in the market is well-founded. It's also worthy to note, I think, that most investors and speculators have only woken up to gold in the last 18 to 24 months. But the truth is that the nominal price of gold, which is to say the price of gold measured in US dollars, has increased by 9% compounded annually for 25 years. But I think that's what's important for people to understand.
Yes, definitely. So, Rick, right now, gold is up. The metal is up over 50% in the year. The miners are up over 130% in the year, leading the entire market. So, do you think there is a near-term top? What are you doing these days in your portfolios?
My portfolio is different than most people because I entered the space earlier. Specifically, in the more speculative part of my portfolio, that part of my portfolio concentrated in market capitalizations under $250 million, I've liquidated 25% of my portfolio. By doing that, I have been able to pay off my whole acquisition cost, which is to say, by selling 25% of my upside, I have eliminated 100% of my downside. My circumstance is different than most people. Most people entered the gold equities market in the last 18 months, and they don't have as much gain to shelter. I also differ from other people in that I've been lucky in life And some of my positions are very large. There were at least 3 holdings where I accounted for more than 5% of the market capitalization of the companies and substantially more of the share float. If you have very large concentrated positions in illiquid companies, you take volume where you can. I have not exited the gold trade. With half of the proceeds of those sales, I have purchased physical gold and or shares in Franco-Nevada, Wheaton Precious, and the Agnico Eagle. In other words, the very high quality companies. I expect the sector to continue to do very well, as we'll discuss later in the interview. But I think the froth in the speculative markets is overdone. And I decided to take some money off the table there.
That's very interesting, Rick. So if I may follow up on that, among retail investors, one of their biggest fears is that if I sell now and it goes up another 50%, am I losing money? So I understand that you're coming from a risk management perspective. You're cutting these, so to speak, more speculative positions. But for my viewers, could you go into a little bit deeper about the psychology? Are you worried about, leaving money on the table?
Early in my career, in the decade of the 1970s, when all about me were losing money, I was into resources and precious metals. And as a young man, I made a truly stunning amount of money. My problem was that I drank the Kool-Aid. I didn't understand that markets work and were sensible. And in the early part of the decade, when the trade turned against me, I went from being very wealthy to having a negative net worth. I am no longer impacted by fear of missing out. I couldn't care less. I understand precious metals, natural resources, and conventional financial services. I don't invest outside my area of expertise. I haven't invested, as an example, in technology, which meant that I haven't participated in the technology boom. I didn't participate in crypto because I don't understand them. I have absolutely zero fear of missing out. I have a large fear of making mistakes. And there is so much opportunity within the sectors, conventional financial services and natural resources, that I know well, that I don't feel the need to act outside of my sphere of competence. Many speculators, I suspect, don't have a sphere of confidence or competence, and the consequence of that is that they need to venture out of it. Fear of missing out is one of the great investing sins.
So, Rick, I understand that I understand what you're saying, but if I may flip the script, right? A lot of retail investors, they really fear this. They fear holding the stock or whatever they own over a weekend. They see the price,
Yep.
I don't know, drop 10%, and they're like, "Oh, my thesis is done. I'm out of this position." So, have you had any experience where you had a large unrealized loss, but somehow you managed to hold on? What was going through your head when you were holding on to those unrealized losses?
That's happened to me a lot. Fear, I think, stems from ignorance. I believe that money is made on the delta between price, what something is selling for, and value, which is what it's worth. Warren Buffett was quoted as saying, "You shouldn't buy a share of stock if you wouldn't be delighted to see it fall 30% in price the week after you bought it, so that you could use the same intellectual capital to increase your position." Now, sadly, I've tested that thesis quite a few times. Let me tell you a story. In 1998, I became convinced that the uranium price had to go up. The industry was making uranium at a cost of $30 a pound and selling it for $8 a pound, losing over $20 a pound and trying to make it up on volume. And I was looking for a way to express my preference. And I stumbled on a little tiny company called Paladin. At that point in time, a 1.8 million Australian dollar market cap, truly a tiny company. And I led a financing and participated in the financing for $2 million in a company that had a 1.8 million market cap. In other words, in In the offering, we bought more than half the company. And initially, because we breathed life into the company, it did well. We financed it at 10 cents with a 15-cent warrant, and the stock went to 11 cents and 12 cents and 13 cents. And then it started to deteriorate. 11 cents, 10 cents, 9 cents, 8 cents, all the way down to a penny. If you have a 90% paper loss, you don't have a hold. You have a buy or you have a sell. I refreshed myself with my investment premise. I decided that I was right and that the market was wrong. Bought more stock, unfortunately not at a penny, but at a penny and a half. And I watched that stock in less than 7 years go from a penny to $10. And the fear that you describe, I think, is because most investors either don't know how to or don't take the time to understand the value of the companies they're investing in. They pay attention to the price because that's easy to get. It requires no effort. But the money is made on the delta between price and value and price and expected value. If you have no sense in your mind of what something is worth, its price ought to be irrelevant. We backtested my portfolio. When I say we, some interns, and we focused on those decisions that had resulted in tenfold escalations in share prices, which is to say 10 baggers, trying to look for commonalities. And we found several, which we can talk about if you like. But the two that are germane to this conversation is that my average holding period for a 10 bagger was 5 years. People who experience trauma holding stock over a long weekend will not own positions for long enough to benefit from compounding. And compounding is how you make money. A second lesson I learned is that over 90% of the 10 baggers that I enjoyed and all of the 20 baggers exposed me to a 50% share price decline during the period of time when I owned them. So in addition to being patient, you have to be persistent. I would suggest to you that a speculator who has no sense of the value of his speculation will not have the courage to own, never mind buy, share price declines. My success had to do with the fact that I drew a very narrow circle around my circle of competence, and I only participated in industries that I understood well enough that I had a strong opinion as to value, which allowed me to weather the psychological trauma of these share price declines. And having a process, actually doing the work, having a thesis when I bought a stock about why it was going to go up and how I was going to know if my thesis was mistaken.
So Rick, I want to follow up on the 10 baggers, but I also want to follow up on your methodology. You mentioned that you have to have a process, right? So what would be your process if you could describe generally to determine the value of a company?
Well, I need to tell you, first of all, this is an unabashed commercial. At the Rule classroom, we have something called Introduction to Natural Resource Investing, which is a free course that tells people how to do it in length. But I'll summarize things. And by the way, the methodology varies between investment quality securities and more speculative securities. In smaller companies, the whole discussion begins with people, the managers, whether they have a track record of success and whether the success that they have enjoyed is applicable to the task at hand. Meaning, as an example, if someone tells me that he or she was a success in mining, but that had to do with managing an operating gold mine in Archean terrain, 2 billion-year-old terrain in French-speaking Quebec, but the task at hand is exploring rather than producing for copper-gold porphyries in 15-million-year-old rock in Spanish-speaking Peru, the successes aren't applicable. So you have to have a successful management team, but you have to have a team whose success is related to the task at hand. The second thing that you need to do is you need to determine what the probable liquidation value of the company is. If the company has a $50 million market cap, but the assets, if they were sold on the street to a willing buyer, would be worth $1 million, you have a 98% potential drawdown. I'm not trying to say that you have to buy dollar bills for dimes. I'm just trying to say that you have to measure your downside before you worry about your upside. Many times in bear markets, you are able to buy assets with a liquidation value in the $200 or $300 million range for market capitalizations that are half of that, which is to say, at the beginning of the equation, you're buying dollar bills for 50-cent pieces. The third part of the equation is in speculative stocks, in the small stocks. Let's back up a little bit. The other thing I try to do is I try to be where my opposition isn't. I try to be in sectors that are out of favor. The gold and silver sector, as an example, in 2020, 2021, was hated if people bothered to understand it at all. So I had no competition. I was able to buy gold and silver companies that I thought were high quality companies after having had the luxury of taking time. The easiest money that's made in a sector is when it passes from hated to tolerated to loved. That's over in gold and silver, by the way. That's done. There are reasons to own it, but the easy money has been made. The easy money now is in stuff like oil and gas that people hate. So it helps to be in a sector that's deeply, deeply, deeply out of favor. We've talked about value. We've talked about management. In speculative companies, the key to success is management's ability to answer unanswered questions. As an example, a speculative gold company may have measured and indicated reserves and resources of 500,000 ounces, but they may tell the market that their target is 1.5 million or 2 million ounces. The unanswered question is whether that's true. Can they, first of all, do they have the 500,000 ounces? But can they get to 1.5 million or 2 million ounces? And that unanswered question is answered in phases. And it's the speculator's job to look at the unanswered question and figure out what a yes answer would be worth in the future, whether or not the testing methodology required to test the thesis or offered up by management to test the thesis will answer the question and is efficient, how long it will take to get a yes answer, and how much money it will take to get a yes answer. And by the way, whether or not the company has the money. And this again goes to your time preference. Let's say that a drilling campaign is required to validate a thesis that's based on surface sampling and trenching. And let's say, just for fun, that this project is in northern Canada, which has a fairly short drilling season. So the drilling campaign would rationally take 2 years. That means that I have to have in my own mind, a 2-year time frame for my investments. Many shareholders who aren't as diligent in understanding the process might in their own mind have a 3-month time frame. Why would they get share price appreciation in a 3-month time frame when it takes 2 years to unlock the value? So causing your time preference to be correlated with the time required to answer the question at hand is critical. Another question is the discipline to sell if you get a no answer. Many people buy a share of speculative stock for $1, anticipating or not thinking that some set of circumstances will propel it to $3. If the stock falls from $1 to 70 cents, many people say, well, I'm going to sell when it gets back to $1. In other words, they think the price that they paid for the stock has some importance. The truth is, and this is critical, if the reason to own a stock goes away, you must sell the stock, irrespective of price. Losing 30% of your money is statistically very preferable to losing 100% of your money. And that sell-side discipline to psychologically admit mistakes and salvage some money is of critical importance for a speculator.
I absolutely agree. Rick, you mentioned education, you mentioned discipline. So for a retail investor that's not working in this space, how can they build themselves up to have the knowledge, have the discipline that you described to potentially get a 10-bagger and not worry about if my stock is dropping next Monday or whatever?
The first part begins with investing in yourself through education. For people who are new to investing, in any facet, be it technology or anything else, there is some reading that I recommend. The first book would be Economics in One Lesson by Hazlitt. I know that your audience is largely Mandarin speaking, and in fact, this book has been translated into Mandarin. This book talks about the way the economy really works, not the way the press or the government would like you to believe it works. It's a useful underpinning. The second book is the absolute investment classic, The Intelligent Investor by Ben Graham. The people who read this book and employ the lessons will, over the course of their life, if they read it young enough, become rich. Not they might become rich, they will become rich. But you can't just buy the book. You have to read it, and then you have to employ the lessons. If people found The Intelligent Investor to be an easy read, the next book they should buy is Securities Analysis, also by Ben Graham. This is absolutely the gold standard of investment books. It was the inspiration of this poor boy, Warren Buffett. He did pretty well employing the lessons that he learned in Securities Analysis. This is not an easy book to read. If that book was of interest to people and helpful, to me, the most impactful book I ever read was Human Action by von Mises, who talks about the way that thought processes and incentives work on human beings, but particularly investors. This is a hard book. And for primary Mandarin speakers, it might be very hard. The book was written in very turgid German, and it was translated into equally turgid English. I don't know if it's been translated into Mandarin, but I bet if it was, it's a truly ponderous book. But it's also, for me, the most impactful book I ever read. Once you have a background in investing, it's time to invest in your knowledge about resources. I, of course, would advocate, among other things, going to the Rule classroom, which is free and has 230 hours of instructional programming. But that isn't the only source. You need to know enough rudimentary accounting so that you learn to read a balance sheet and an income statement. Most people don't do this. Most people's investment methodology is got a hunch, bet a bunch. And that doesn't work. It just doesn't work. But the truth is, with rudimentary knowledge of accounting, really, truly rudimentary knowledge of accounting, you can understand a balance sheet and an income statement, and then start doing it. Start doing the work. We recommend that every speculator who follows our work owns the numbers of stock, the number of different companies that corresponds with the number of hours per month that he or she is willing to work understanding those companies. So if you're willing to divert 10 hours a month from your day job, your family, your recreation, then you should own 10 stocks. If you're willing to devote 20 hours, then you can own 20 stocks. What I find, and I've interviewed tens of thousands of investors in a process I'll describe later. What I've found is thousands of people who own 50 stocks, 60 stocks, 70 stocks, and devote 1 or 2 hours per month to study. That doesn't work. It simply doesn't work. I have now, and this is an offer for your listeners, at my website, ruleinvestmentmedia.com, I rank people's natural resource portfolio for free. If you go to the website, list your natural resource stocks, I personally will rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments have value, and that's free. The consequence of that is that I have been able to look at almost 100,000 portfolios in the last 20 years and ascertain what people do well, what people do poorly, what the consistent mistakes are. I'm tempted to say I've learned as much as I've taught in grading all of those portfolios. And the cardinal sins that people engage in are, first, just not doing the work, so they don't have a chance of success. The second is that most people are anti-contrarian. When gold is selling for $250 an ounce, they don't want to own it. And when it's selling for $4,000 an ounce, they can't wait to buy it. I'm not saying it's done at 4,000. What I'm trying to say is that the hate trade is done. People are anti-contrarian as opposed to pro-contrarian. And the third thing is that most people's time preference isn't suited to investing. Most people think in weeks or months. And in investing, you have to think in terms of years. I had the good fortune, and I don't want to make this ethnic necessarily, I had the good fortune in the decade of the 1970s to come to know a fair number of overseas Chinese investors in Vancouver. And I need to say, at least that generation of Chinese they didn't have a problem with time preference. I remember being outbid by a Hong Kong Chinese guy in Vancouver for a building in downtown Vancouver. And I asked him how he justified the price he paid. And he said, I'm buying this building for my grandson. He said, in this case, your time frame is too short. Now, there are other ethnic Chinese investors who frequent the Hong Kong racetrack who have a very different time preference. And I would suspect that they won't do as well as this gentleman who outbid me for the building in Vancouver.
Yeah, time preference is huge. Nowadays, everybody wants, triple leverage, 3 times, 2 times. There's perhaps hundreds of thousands ETFs out there that's currently leveraged, and they're all passive. So this situation, pairing with what you're saying about, people can't wait to buy gold at 4,000, makes me slightly worried about the near-term performance of gold and gold equities. I have no doubt in my mind, 2-3 years from now, gold is going to be at a higher price. Gold equity, GDX, SGDM, they're going to be at a higher price. But now it seems like everybody wants a piece of pie. So at this time, could you explain to us how to make it easy for ourselves to be like, okay, I can sell here. I'm not going to be worried about the future or how many percent goes up or time frame. How can you calm yourself down like that?
Well, I think it depends on whether or not you own any gold. If you don't own any gold, I think the outlook for the next 10 years is such that you swallow twice at 4,000 and you buy it, knowing that over time it's very likely to go higher, but also knowing that it isn't improbable to see it decline in the near term. I think it really depends on who you are. A rational financial planner would look at my portfolio. I'm the largest shareholder of Sprott, which is in effect a brand name for gold. A rational financial planner would say I shouldn't own any gold at all, and I own a lot. I save in gold and I maintain liquidity in US dollars because I think it's inevitably going higher. I wouldn't be freaked out at all by a 25% decline in the gold price. I'd buy more. Here's one example for your listeners, particularly your younger listeners who didn't endure this personally. In the decade of the 1970s, the last time that there was a precipitous decline in the purchasing power of the US dollar, the gold price went up 30-fold. In the middle of a market where gold went from $35 an ounce to $850, specifically in the year 1975, the gold price fell by half, and the gold equities fell by 65%. A 50% decline in the gold price didn't derail the bull market. It was a cyclical decline in a secular bull market. There were people who in the first half of the market enjoyed the rise from $35 to $200. And of course, having experienced a six-fold increase in price, were devotees to gold. When the gold price fell from then $200 to $100, fell by half, the faithful came to despise gold. They got shaken out at the bottom, and they missed a move from $100 an ounce to $850 an ounce. So people who buy gold need to understand that they're buying gold because of the probability of it doing well over 3 years or 5 years or 10 years. But they need to steel themselves to the circumstance that you could have a cyclical decline or you could have volatility. You have to have the psychological wherewithal to stay the trade. I'll tell you how I do it, if you'd like. My thesis for gold is as follows. Gold does well when people are concerned about the maintenance of their purchasing power in fiat-denominated savings products. So, are those fears valid? Let's look at the US dollar. The on-balance sheet liabilities of the US government exceed $37 trillion. The off-balance sheet liabilities, which is to say Medicare, Medicaid, all that, exceed, according to the government, $120 trillion. So the aggregate obligations at the government level, federal government level, exceed $150 trillion. The private net worth of all Americans combined is estimated by the IRS to be $161 trillion. There's not a lot of margin left, $11 trillion. And the deficit on balance sheet and off balance sheet combined increases by $4 trillion a year, which is to say our debt eclipses our private savings in 3 years. Gross federal income is $5 trillion a year. Gross. That's the money the government takes in before they spend a dime. The on-balance sheet liabilities of the government increase by $2 trillion a year, which is to say 40% of gross federal income. And the off-balance sheet liabilities increase by another $2 trillion a year. I believe that the United States has two choices. They can have an honest default, where they say to bondholders and entitlement holders, too bad, so sad, money's all gone. Or we can do as a society what we did in the decade of the 70s. We can allow the purchasing power of the US dollar to decline by 75%, which is what it did in the 70s. Remember that in the 70s, as the purchasing power of the US dollar declined by 75%, the gold price increased 30-fold. I'm not suggesting, by the way, that the gold price is going to increase 30-fold from here. It's already increased 12-fold since the year 2000. But I believe that the gold price is likely, in a nominal sense, to increase in a degree that corresponds with the decrease in the purchasing power of the dollar. That means over 10 years, it wouldn't surprise me at all to see the gold price increase 3-fold or 4-fold. And it wouldn't surprise me to see the price of gold equities, high-quality gold equities, increase faster than the gold price. But it's important to note that that occurs over 10 years. And in that 10 years, it is not unlikely that we experience 1 or 2 serious declines. So the bet needs to be right-sized, which is to say the investor needs to have that proportion of his or her portfolio in gold that corresponds with their need, and also corresponds with the level of psychological abuse that they can endure if they experience cyclicality and volatility. I hope that long-winded explanation helps.
Yeah, for my viewers, gold is actually pretty volatile, if you look at history. But I totally agree with what Rick is saying. Since 2022, I just had this feeling in my heart that the government, they're addicted. They're absolutely addicted to printing money. Like you said, the nominal value you're getting seems to be okay, but when you go out to Costco, you're not going to be coming home with steaks. That's costing way more these days. So that's kind of why I'm hugely bullish on gold. I'm guessing that's why foreign central banks who holds U.S. Treasuries are stockpiling gold. Would you say that's the case, Rick?
I think there's two reasons for that. I think the decision by the U.S. government and the U.S. voters to weaponize the dollar is a different reason. Whether or not you agree, as an example, with Russia's action in the Ukraine, the U.S. government stole $300 billion worth of Russian assets denominated in U.S. treasuries. The U.S. government also utilized the SWIFT banking system and the dollar status as a reserve currency to enforce extraterritorially the preference of the U.S. government on foreign governments. That lesson wasn't lost in countries where they see themselves perhaps having policy disputes with the U.S. government. And these weren't small countries. Think the People's Republic of China. Think the Republic of India. Think Brazil. Think Saudi Arabia. The U.S. government left foreign governments no choice but to diversify their savings partially away from the U.S. Treasury so that the U.S. Treasury couldn't use foreign holdings of U.S. Treasuries to impose U.S. Policy territorially on other people. Years ago, 2010, 2011, 2012, used to trot around the world selling Sprott institutional products, particularly gold and silver trust units, but also more applied strategies to sovereign wealth funds and foreign investors, particularly in Asia. And I learned some interesting things. At that point in time, the U.S. dollar was really, truly, supreme. And I would visit with my counterparts who were portfolio managers for sovereign wealth funds or, foreign central banks, stuff like that. And I'd look at their portfolios and they were just stuffed with long-term U.S. treasuries. And I would say to my counterparty, this is very flattering for me as an American. You send me all kinds of cool stuff, cars, computers, steel, and we send you back dreams and promises printed on pieces of paper. This is a hell of a trade for me. How do you feel about it? They were normally too polite because I was American to describe that. And then I would say, listen, when I look at the U.S. Treasury and I look at the long-term implications of the U.S. debt and deficit, the Treasury to me, despite the fact that my government issues it, feels like a lie. And I remember very well one particular gentleman looking back at me and smiling a bit and saying, what you say, Rick, is ultimately true, but yours is a deep and liquid lie, unlike the other lies that people tell us. Having gotten this break in the conversation, I said to him, do you trust us? And he said, oh, no, but we trust you more than we trust each other, which meant that if you were Chinese, you didn't trust the Japanese. You didn't want yen. And you certainly didn't trust the Russians. You didn't want rubles. So you held your nose because of the liquidity and the transparency around the U.S. Treasury market, and you held U.S. Treasuries. The U.S. over 25 years has debased that wonderful franchise, which is truly sick. It's truly sick. But we gave those countries no choice but to diversify out of U.S. dollar-denominated savings products. The other problem, of course, was that arithmetically, the U.S. Treasury is a lousy deal. If you're getting paid 4.5 or 4.6% in a currency where the real purchasing power of the currency is deteriorating by 8%, you're not making 4.5%. You're losing 3.5%. The combination between assigning seniorage to somebody who may be your enemy, while at the same time investing in a piece of paper that guarantees the diminishment of your purchasing power, is, I think, what has led foreign central banks increasingly to diversify in gold. You'll notice that they're not increasing their holdings in each other's currency. They are not substituting renminbi or yen or euros or rupiah for dollars. They're substituting gold for dollars.
Absolutely. Rick, we're coming up on time. We have a last couple of minutes. I do want to come back on your Rule classroom, your book camps. This is actually something that I'm personally hugely interested in. I'm planning on signing up. I want to be worked hard. But for my viewers, can you tell us a little bit more what your program, what kind of audience is it aiming at? What type of people should come to you and learn?
There's 3 ways to interact with me. The first, we'll call it the starter drug, is Rule Investment Media. If you go there and list your natural resource portfolio, I'll rank it for free. Please no crypto. Please no tech stocks. Please no pot stocks. Please no bonds. Natural resource stocks only. I'll rank it. That's free. And if you post questions and comments there, I'll try where I can to answer them. The second level of engagement with me is the Rule Classroom. The Rule Classroom has something like 230 hours of instructional programming. We also have a weekly question and answer session, at least those weeks when I'm in town, where I answer viewer or member questions. There are 15,000 members to the free portion of that classroom, which is to say access to the discussion groups, access to the question and answers, access to all the programming and all the interviews is free. ruleclassroom.com. 15,000 members. About 2,000 of those 15,000 subscribe to the paywall part of the Rule Classroom. That allows them proprietary access to some interviews, early access to other interviews, and it allows them to frame the questions that are answered in the question and answer session. Anybody can listen, but only paid guys can ask. And then every 90 days, we offer up an online course called a boot camp, where we take one particular topic. We've done silver, we've done uranium. We just did a 3-part series on gold, where we explore the topic in depth for 8 hours. Importantly, we give you more information in 8 hours than you can absorb in 8 hours. So we give you access to the recordings of the course for a year. Because in the primary 8 hours, you aren't going to get all the information we give you. You're going to have to play the tape once or probably twice. We charge $99 for this, which includes a year's access to the tapes. And it comes with an absolute money-back guarantee. If you think for any reason, including your own lack of preparation, that you didn't get your money's worth, I'll give you your money back. Now, the caveat is that you have to have participated. You have to have attended the course and paid attention. But if for any reason you think you didn't get your money's worth, I'll give you your money back. In 40 years, by the way, of giving money-back guarantees for investor education, I've had to refund less than 0.1% of the tuitions charged. That notwithstanding, there is a money-back guarantee. Beyond that, once a year, we do the Rule Natural Resources Investment Symposium. One can either attend live in Boca Raton, Florida, or in the comfort and convenience of your own home via live stream. Again, we give you more information over 4 days, 46 hours of programming that you can possibly absorb. So again, you have access to the recordings and you'll have to use them. And again, this comes with an absolute money-back guarantee. If for any reason you think we didn't give you your money's worth, whether you attend live or via live stream, we'll give you your money back. That's how you can interact with us.
Thank you, Rick. Sounds like a no-risk bet with unlimited upside potential, right? Sounds like a good trade. Thank you, Rick, for coming in today and then sharing with your knowledge. All of this, all of you said is super, super interesting to me. So if you're willing, I would love to have you back sometime in the future.
Absolutely. This is what I do. I enjoy the process myself. You know, in my life, I forgot to say that all of the success that I've enjoyed is a consequence of mentors that I had when I was a young man. And for me not to try to teach others would dishonor the memory of the people who made me the success I am today. My joy, outside of the fact that I like making money, I do, is helping people the same way that other people helped me when I was young. I would not want to dishonor the memory of my mentors by not attempting to mentor other people myself.
Got it. Thank you very much, Rick. We're coming up on time. I want to thank you again for coming in today and speaking with us. Good luck with everything. We'll see you hopefully next time.
希望大家看完了今天的视频之后呢，觉得今天的内容非常的精彩。如果你觉得精彩的话，请点赞、转发、关注。平常我都不会这样说，但是今天的这个节目，我觉得真的是非常的特别。如果大家想去看一下 Rick 那边是怎么样培养一个专业投资人、机构投资人的话呢，他的所有的网站以及他推荐的几本书都在这个评论区。感谢大家所有人的观看以及支持，我们下次再见，拜拜。